Rob, how's it going there? Great to see you again. Thank you
Great
so
to
much
see
for
you
the
back.
opportunity to have you to have a little bit of your time. I know you're super busy, all over the place, but also at the same time extremely focused. Seriously, I
It's
really have the
nice to be here. It really is nice to be here with you, Roger.
look, Rob, you're a legend in our business, right? You really are. You're one of the very few advisors in our industry that has built a monster business at big banks and brokerage firms. I'd like to talk to you a little bit about how you grew your business, and the evolution, right, of your business at the big banks and brokerage firms to where you are today at NewEdge. It'd be really great to know how you built your business, how you grew, how you maybe even started. If you can tell us a little bit of story about your background, really appreciate it.
Try to condense a 27-year-long story into something abridged for your podcast here. But I'm originally from Pittsburgh, PA. I grew up there. Coincidentally, that's where Edge Co's from. That's my financial backer, and that's the headquarters of this business. They're one of our principal investors and partners, and of course, they're backed by private equity, which includes Parthenon Capital Management and Waterfall Asset Management, who we interact with regularly. I spent most of my life in Pittsburgh, ended up going to Carnegie Mellon for both undergrad and business school, graduated from the Tepper School of Business in '96, and then joined Morgan Stanley. And a lot of our team's foundation goes back to Morgan Stanley. My partner, Jeff Kobernick, started there in '94. I was hired by our current president in '96, and many of the members that kind of work in and around NewEdge trace their roots back to Morgan Stanley. And I think one thing that I would say is back then, maybe even today, Morgan Stanley was a really special place. The firm had all the resources of a global bank. They had really distinguished investment insight. They had a boutique culture in the wealth management business, as there was only about 300 advisors there. As many of your listeners probably know, Morgan Stanley merged with Dean Witter in 1997, and the integration of those two businesses happened a few years later, and it changed the culture of the firm from a place that was about the resources, about intellectual capital, about culture, to a place that was about advisors. And me as an advisor, that should feel great, but you're only as great as the arrows that you had in your quiver. And so that integration was one that was a bit painful for teams that came from the Morgan Stanley side of the firm. We decided to pack up our bags and go join Lehman Brothers to regain some of what we thought was special and was lost at Morgan Stanley as it became a much bigger firm. And for us, it was really a perfect fit. Another boutique, and this is a theme that you'll hear throughout this, it rhymes throughout my whole conversation, with global capabilities and a terrific culture. And unfortunately, as we all know, Lehman failed during the financial crisis, and we were forced to go again and find another home. I always like to say that I would have probably bled green for quite a long time if Lehman stayed around. The good news is our friend John Strauss, who was the head of the wealth management business at Morgan Stanley while we were there, he took a brief time and went and ran JP Morgan's private bank and then ended up at UBS, and we just rejoined him there. And so that's actually how we ended up at UBS after the financial crisis in '08. And that's where we built a business that became at scale. When we left, it was about $5 billion in assets. So it was a really nice practice at a big firm.
It's a great story. How did you build such a substantial business? How did you differentiate yourself? How did you market yourself? How did you use the infrastructure of these banks to grow a business?
Early on, when you were talking about Morgan Stanley, this was really where I had my substantive growth, was at Morgan Stanley and Lehman Brothers, and then, continued the trend at UBS, but it was really trying to stand on the shoulder of whatever the giant was at that time. And at Morgan Stanley, it was the intellectual capital. It was Barron, Barton Biggs, Stephen Roach, really great investment capital where I could go into a meeting and talk to clients about the firm. and play for the name on the front of my jersey, not the name on the back of the jersey. So as a younger advisor in the industry, I was able to distinguish myself by the resources at the bank. And in that case, it was Intellectual Capital on the investment side. We also had the good fortune that they had bought a business. John Strauss led that acquisition called Greystone. And Greystone was really the consulting business that's now still the consulting business at Morgan Stanley. But the idea was to take yourself and move yourself to the same side of the table as the client. And I think that was really distinguishing for me as a practitioner on that platform. Fast forward to firms like Lehman Brothers and firms like UBS. The capabilities of these firms expanded over time, mainly on the capital markets and lending side. And I think what we were able to do is, again, take another pillar of differentiation and build upon it. And I never was the advisor that just built based on my own skill set. I tried to bring in the resources of the firm. And what invariably ends up happening at these firms, and you have to make a commitment to make sure that this doesn't happen, is as they grow, as they become successful, what ends up happening, there's a lot of strain on those resources if they don't continually invest in them. And there's this constant tug of war between profitability and investment in the resources. And so I think that's, you really have to be able to thread that needle. And over time, I think me personally, I became increasingly frustrated with the ability, despite the fact that I'd loved everybody at every one of those firms, and they were tremendous for my career. And I could tell you that each one of them played a pivotal role in the foundational success of NewEdge. I learned a lot, right? I learned how to navigate different cultures, different firms, different resources that propelled me, my team, and our clients to success. And at the end of the day, if you can't make an organization work for your clients, you're not going to have success.
Understood. So you got to a point where you needed more resources. You started looking in the independent world. And so what led you, I suppose that is what led you to look into the world of independence, and what led you to, in the end, to decide to create NewEdge?
The concept of advisors going independent, Roger, is not new. It's widespread. It's consistently growing. I would say that for the same reason that families start family offices, there's this idea that by being a central organization and effectively becoming a customer of the street, you better your positioning and better your ability to advise clients. I mean, and so it works because the statistics are wildly compelling in terms of the numbers going independent. The big firms, their assets are increasing, but their market share as a percentage of the total are decreasing. And I just felt exploration was mandatory from my lens. If you're going to do what's right for clients, one of the things that you have to do is make sure you're out there focusing on what could be next, what could be better, and not be so myopic in looking through the lens of one organization. And so understanding the competitive landscape to see what clients would be exposed to if we were independent before establishing NewEdge, and really questioning the existing options, exploring alternatives. And, I was doing it and I knew my clients were doing it at the same time. They were thinking about family offices. They were thinking about multifamily offices. They were thinking about independent firms. And I had a duty to get out there and think about it as well. And when I saw it, I couldn't unsee it.
And that's where I might not challenge you, Rob, but advisors are challenged, right? Because they don't know what they don't know. They feel that these large banks that have incredible infrastructure, right? From alts to structured products, to lending solutions, and trust services, and on and on. And of course, their interest is to do the best interest of the clients. They have incredible resources, but what is it that they do not have that you do, that they are missing?
What I would say is advisors don't take the time to do that because they're very busy. They're very client focused. To their credit, their heads down and they're making sure they're taking the toolbox they have, making sure they're doing the best they can with that toolbox for their clients. But the reality of it is, and I think anybody will tell you this, there's no one firm that has a monopoly on great ideas, products, or services. There's lots of great firms out there. And it's as simple as this. If I were to be a client of Wall Street, having been on the inside, having worked at a number of big firms, I would be a client of multiple firms and expose my clients to the best solutions available for their particular need. And the very fact is you can't do that at one firm. Use lending as an example, okay? You have a client that needs a large mortgage. When I was at UBS, when I was at Lehman Brothers, when I was at Morgan Stanley, I had one solution for them. I could not shop the street. Today at NewEdge, we have partnerships across the street. We've placed mortgages at 14 different banks. We've done structured loans with hedge funds, with private credit funds. We've done lots of different things that I couldn't do. I couldn't apply that level of competitiveness. I couldn't apply that level of sophistication to those client situations. And therefore, what it does is it creates a gap in the armor because the client feels like they have to play that role. They can't count on you because structurally you're disadvantaged. You're at one place. Doesn't mean you're not going to do a great job for them. It's not confidence inspiring that you're battling for them throughout your internal ecosystem to make sure you get them the best price that you can. But the beauty of competition, Roger, it absolutely makes that happen because when you put 2, 3, 4 banks in competition with one another for a structured trade, lending solution, a mortgage, or execution, you're going to get a better outcome. Today, the technology exists to bring all that together in a very seamless way. And NewEdge is one of the firms that's bringing that technology together to allow great advisors to have those deliverables to clients in a very nice, tight package.
So let's talk about the NewEdge advantage, the platform. What differentiates the platform? What differentiates your firm? How is it better for clients than the vast use of resources that you have?
We talk often about the pillars to what makes us different. And one of the most disruptive forces in our industry today, and I think most people thinking about it wrongly, they think about it as something that's going to disrupt the advisor-client relationship, and that's technology. And it is disruptive. There's no question about it. You can't turn on the TV today without hearing something about AI. When I think about technology, it can be the connective tissue between advisors and their clients. And how does it connect advisors with clients? We use it to better price. We use technology to better execution. We use technology to organize information. We use technology to help us better think about risk management. We use technology to help us organize everything in a client's financial life and make it better and actually enhance that competitive framework that I talked about. There's technologies that do all that. The fact is, when an advisor sits back and looks at that, they're often overwhelmed by the choice of everything that's out there. What's going to be around tomorrow? How do you do that? In NewEdge, we have 130 people that work in our technology group that are full on integrating these type of technologies to make sure it's a seamless deliverable for advisors with their clients. So one of the pillars is using financial technology to drive a structural advantage. And big firms I know people are going to say, well, big firms have access to all the technology in the world. The thing is, it's very tough to pivot a legacy infrastructure and very tough to embrace that technology very quickly. So that's one. Two, we talked about as big organizations grow, there's strain on the intellectual capital resources, whether that be on the wealth strategy side, so the trust and estate, the tax, the structuring, or the investment side. And we've been very purposeful about when we invest in intellectual capital, we're going to have a very high resource to advisor ratio, and we've committed to it over time. We are going to invest as we grow the advisors, the intellectual capital grows with it, both on wealth strategy and the investment side. And we've hired, in my opinion, some of the best and brightest out there to join our team to really deeply get involved in client relationships. When I looked at the big firms that I was part of, they had these centralized groups that were really like Navy SEALs, but there's no way they could fight the war that needed to be fought with all the advisors that were out there to really deeply get into their client situations and relationships. It was far from a family office experience because these people were insight providers. They weren't really getting in there and doing the work. They weren't fighting the fight. They weren't in the trenches with the advisors and the clients. We have a totally different model. These people are deeply in these relationships. They are the experts and they're involved at every step of the way. And what ends up happening is I think you get a better outcome. That's structurally different. So that's structural advantage number two. You look at the investment side of things, I think there's a huge allure for the best and brightest out there to be part of an organization that's a consumer of a lot of what's out there, right? Want to be independent thinkers, okay? And we have the structure that allows for that. And we have attracted a number of investment people that are just super, super differentiated, whether that be Cameron Dawson, our CIO, Ben Emmons, our head of fixed income. We're making a huge municipal hire this week. It'll be announced next week. I wish I could talk about it on this phone, but came from one of those big firms that I worked for and managed significant amount of assets. Our quantitative equity people. These are people that leverage technology, that leverage the street, that leverage insight and help our clients drive better outcomes. We have had exceptional performance, both from an asset allocation and an implementation standpoint. We're very proud of that. And so it's this very deep intellectual capital to advisor ratio that's only growing at NewEdge. It's not going to be scaled down. So as advisor population grows, it grows. Last thing is, because we're part of EdgeCo, I didn't mention what EdgeCo is, but EdgeCo is a financial holding company, and it's a $170 billion asset company, of which NewEdge now is proudly 44 billion. And, really we've grown a lot in the last 3 years. But what EdgeCo enabled us to do, Roger, is it enabled us to start halfway up the mountain. I mean, we could have never had the resources that we had as a boutique RIA, nor the punching power that we had with the assets that EdgeCo is responsible for, to be able to resource the operational parts of the business the way that we have. We have, nearly 20 people in marketing. We have, a complete financial team. We have a complete HR team. And I mean, we just got to really only focus on the summit and not worry about how to get to base camp. We knew there was fully resource base camp. And I'll tell you what, that advantage and the insight that comes from having institutional investment partners in Parthenon, in Waterfall, that prevents somebody that was stepping out of a big firm environment into the independent world and running a firm. It's helped me and my colleague Alex Goss, who runs NewEdge Advisors, which is the other part of our NewEdge businesses. We have two parts to this business, one focused on mass affluent, one focused on family office, but both are geared towards elite advisors. And each of us would speak to the virtues of having partners like EdgeCo, having partners like Parthenon and Waterfall, that have made us better than we would have been on our own.
Amazing story. So advisors today, Rob, are trying to make the decisions whether or not they want to create their own RIA, but joining an existing is a tough decision for them, particularly since there's not many businesses that are started by previous entrepreneurs like yourself, advisors at big banks and brokerage firms that don't have that pedigree and experience. Joining existing RIA, it's very difficult to have that trust. So it's either starting their own or joining an existing. There's very few like your organization that have the breadth and scale and capability, but also experience of working on Wall Street to join you because you understand their business. You understand the trials and tribulations of starting their own firm. And so joining your infrastructure, joining what you've already, as you say, it's only 3/4 of the way built, if not more, right, is an easier decision. Let's talk about the economics behind it as well, right? Not only is it
I want to comment before we get to the economics just on something you said there. I think it's really important. We've taken great lengths to have some institutional trust here. And there's a number of layers to it, but the foundational business of EdgeCo has been around since 1983. Our company is the longest standing custody and clearing client with Fidelity. We have relationships with every major custodian out there, long-term partnerships. We have a deep experience in the independent space that predates my arrival and my responsibilities here and predates my co-managing partner, Alex Goss, his responsibilities and his time and tenure here. So that history is important. We also have him and I that were both financial advisors. So we know what it's like facing. And a lot of the founding members of this company were advisors. And that's a huge asset here because we know what it's like to interact with clients every day, and we want to make sure that that experience is a very positive one. The other thing that we did is we've attracted leadership from the big firms that have worked at the Merrill Lynch's, ran UBS, like Bob McCann, right? Super leader, and somebody that I think we're all fortunate to have his mentorship and stewardship as our co-chairman of this company. I mean, it's institute trust that goes with that. A lot of advisors know and trust Bob and have either lived with his experience at Merrill Lynch and it was very positive, or lived with the experience at UBS as I did, and it was very positive. And then John Strauss, who's run every big kind of private bank out there, Morgan Stanley, JP Morgan, UBS. And then one more thing on the independent side, which is super. Steve Pirigi was one of the first employees at LPL, and he's now the president on our NEA side. So we have a pedigree of leadership that I think gives us institutional credibility that allows people to say, hey, when I sit down there, I know this stuff's going to work, and it's confidence inspiring.
As well as your board of directors as well. I mean, I don't know if it's, you're open to speak about it, but I mean, it's some
it's an advisory board than the board of directors. The board of directors is a who's who of investment people. It is the people like Chuck Warden and the Parthenons and Waterfalls of the world, Paul Schneider, who was a senior executive at SunGard. These are great board members, but our investment advisory board is really a who's who of Wall Street. It's Leon Cooperman, it's Kyle Bass, it's Tom Lee, it's Steve Einhorn, it's Bob Matza. These are people that help inform our investment decisions. And again, it's not all about investing, but if you can just, again, stand on the shoulders of giants, it can make you better. And I think we've done that in every aspect of our business.
Amazing. And financial capital behind it, Parthenon Capital. Talk a little bit about them.
I've been incredibly blessed with both them and Waterfall. Parthenon has a track record among the best in the industry in financial services. They're focused on fintech and health tech and tech-enabled solutions. And when you think about the platforms that support an advisor business, you want experience there. And, I often tease them and say they're a little bit like BASF. They don't make the product, they make the product better. And everything that they've done with us, decisions are better. The business that we built is foundationally stronger. We make investments that make a difference, and they are incredibly important partners in a chapter that in our book that is very foundational.
Without getting into specific numbers, Rob, on economics, we understand well that the opportunity not only to cash and a good amount of it at a long-term cap, but also to be an equity partner. And a lot of advisors look at equity and they might say, well, I don't really know what it's worth. And, I might just believe that it may not be worth it, that it's already baked in and there's not much opportunity for them. You talk a little bit about why your equity is valuable today and why it's likely to be a lot more valuable more tomorrow.
That's a great question. First, I would say not everybody's invited in to be partners. We have a very high bar to jump over, and we go through a very rigorous process. We're not trying to cast a broad net. We're trying to cast a net that gets us elite advisors. And so we're laser focused on that. We have two ways to affiliate with our business. One is an affiliate model where you join us, you power your business by our ecosystem, and ultimately our hope is that you sell to us later because you're going to see the powers of the ecosystem and the impact that it has on your business. It is your business. We are totally willing to sign anything that says it's your business. And if you don't like what you're experiencing, you can walk away. That's a high payout model. The other model, as you suggested, is a very compelling equity-based structure. It's equity in cash, but all at long-term capital gain. And the reason I'm confident that the equity is valued fairly is because it's valued based on a multiple of earnings, a current market multiple of earnings that is a discount to what we think the market multiple is. So you're getting value in the equity at T0. There's no question about it. How does it change? Well, if we grow the business, the earnings grow, even if the multiple stays the same. If the earnings are growing, the equity value is going to head higher. Knock on wood, we've had a ton of success in recruiting teams. We just came off a record year of $9.6 billion in recruited assets between NewEdge Advisors and NewEdge Wealth. By the way, the holding company is called NewEdge Capital Group, which I co-head with Alex. But it's been a marvelous success. And I think what makes us different is we have a bucket that we can catch any elite advisor in. Ones that want to start their own business, brand it on their own and use our ecosystem. Ones that want to affiliate with us and carry our card. And ones that want to exchange their equity for our equity because they believe in the dream. And I think it is a great opportunity for those that are invited to own a piece of the platform that you use. And, that's not for everybody and everybody's not for us, but we think we've built something that's special. I can tell you that if I wanted to do this 3-4 years ago, when I was thinking about launching NewEdge, the reason we launched was we didn't think it existed. I would have joined a firm. I would have made it easy on myself. I did not think it existed. At least we didn't see it. And so we started something because we thought there was an enormous market opportunity and all these great businesses. Kudos to Parthenon, Waterfall, the entire board, the EdgeCo legacy execs, that they were able to see this and bring it all together in a way that we could check really almost every box.
From an outsider's perspective, as I understand, you're one of, if not the fastest growing RIA in the country.
Those are your words, but we certainly feel very fortunate.
Well, what I also understand is Parthenon is it when it comes to investing in RIAs and their success of so, right? 3x, 5x, 10x. That's what they do. Backed by 25% owned by Goldman Sachs, and already they've yielded great returns, and you have as well as for your other partners. So if there's any economic opportunity, if invited in the RIA space, this, in my opinion, from an outsider's perspective, is one of, if not one of the best in our industry.
Thank you for that.
To also be part of your infrastructure as well. So you spoke a lot about the infrastructure, and you're also hinted as well on the culture of your firm, right? It's if you can talk a little bit about the culture within.
That's what makes great companies. When we think about culture, it's people who are contributing to the greater good. And we have, if you were to ask anybody that sits in the seats here, and I invite you or any of your listeners to call anybody that's part of our organization and say, what makes that place different? They're probably not going to say the technology, the intellectual capital, the access, the economic opportunity. Those are all great. They're going to hear people say they like working here. They're going to hear people say everybody wants to help everybody. They're going to hear people say that my practice took off when I got to NewEdge. And that's because we have 4 former Barron's top 20 advisors here, right? This is a place where people join and they get exposed, not just to great content, not just to great ideas, but to people who do what they do, might be slightly different, but are all willing to help them be better. And we do a call every morning It's a half an hour. We have people dial in from the West Coast. It's at 8:30. They're getting up at 5:30. And I'll tell you, the reason they dial into that call is because they get value from it, where we talk about things that are relevant to clients today, where we talk about things that we could be doing with clients today, where we really act like a family office and come together and collaborate to do one thing: drive better outcomes for our clients. It's a simple objective. It's not about NewEdge's success. That'll take care of itself if we take care of the advisors and if we take care of clients. And I dial into that call every day. It's must-see TV for me. It's almost like when we were younger, Roger, and Cheers would come on, or Seinfeld. We didn't miss those. So,
Well, Rob, an incredible story. Greatly appreciate the opportunity to take your time today and hear your story. And hopefully the folks can learn a bit about the firm and your rise to success. In listening and speaking with you, as much as you built, as big of an infrastructure as it existed before, as much as you added onto it, including the leadership and the partners that you have, including Parthenon, it feels early. It actually feels really early. It's like in the second or third inning, if that. That's just from my perspective. So again, thank you so much for the opportunity to speak with you.
I would echo that. This is I want to be an advisor for a long time. There's many chapters in my book and other advisor books out there, right? They want to take care of clients. This is something that requires continuous evolution and continuous innovation. And I think one of the things that you bring up often when we talk is what happens when Parthenon and Waterfall exit. You talk about that quite frequently when we interact. And I feel the reality of it is they're institutional investors. They've invested in our company to earn a return on their investment for their LPs, right? And, they have very flexible capital, so they can stay in for a long time, which I'm delighted by. But the reality of it is someday we may have a different institutional partner. And, view that as institutional investors that are going to come in and support your next growth initiative, because they're investing at a point where they want a return on their capital. And so it's self-evident that they're going to dedicate the investment, dedicate the resource to ensure that we continue to be successful in this endeavor that we've set out to achieve.
Well, I'm a buyer. Again, Rob, thank you so much for the opportunity to take your time, and great seeing you again.
Great seeing you too, Roger. Thank you very much.
Thanks so much. See you.